Thank you, Julian. And thanks, Nanhua, for the invitation. I'm Austin Zhang. I'm a partner based in JunHe Shanghai office. Glad to have the chance to talk about the cross-border trading PRC futures and options and share some of our observation and outlook on the latest regulatory changes and opportunities. I promise I will speed up to leave some time for the Q&A. And before this presentation, I got some frequently asked questions from Nanhua team. So foreign investors may wish to get a general idea about Chinese financial regulatory landscape. They are also aware of China's latest financial regulatory reform early this year and may have some concern on this issue. So our first topic is about the financial regulatory framework in China. So in this slide, you can see we have different financial regulators in China with different jurisdictions and functions. We have the National Development and the Reform Commission, NDRC, responsible for formulation and the implementation of national macroeconomic management policies. Previously, we have the China Banking and Insurance Regulatory Commission, CBIRC, supervision over the banks, insurance company, trust companies. But for the foreign investors that have interest in accessing the PRC futures market, they mainly look at the rules from the China Securities Regulatory Commission, CSRC, which governs the equities, exchange-traded products, bonds, and the futures options with commodities as underlying. Also, the rules from the State Administration of Foreign Exchange, and the SAFE, which administrate the foreign exchange control and its inflow and outflow. And in this March, the CBIRC actually is merged into National Financial Regulatory Administration, the NFRA. So we will look at the implication of China's financial regulatory revamp in early this year. And we understand that the PRC financial regulators still focus on strengthening the regulation to prevent risk. So like previously, CSRC is just a public institution directly under the State Council, but now CSRC and the NFRA have become government agencies as part of the State Council, which places them in a higher hierarchy, meaning that they will have more supervisory powers and functions. Also, in the past, the PRC financial regulators adopted the method of regulation by institutional type. Like CBRC governs the banks and non-banking financial institutions, and the CSRC governs those securities firm, futures brokers, and the fund management companies. So
sorry, Austin. Sorry to break in there. We can only still just see your front page. Is that correct, or are you moving through? Perfect.
Can you see it now?
Yes, we can. Thank you very much.
Okay, sorry about it. So we just talk about how the PRC regulators will regulate all the institutions. So there are some like overlapping in the jurisdictions, also leave some space for the regulatory arbitrage. So, but now we have seen the PRC financial regulators gradually switch to a model that to attach equal importance on the regulation by function and the regulation by activities. That means that the PRC financial regulators will look into the substance of the relevant financial activities, that is regulation by look-through, and regulate all kinds of financial activities on an ongoing basis, so as to underscore the need to prevent risk by promoting integrated financial regulation and to eliminate the regulatory arbitrage. Also, some duties of the PBOC and the CSRC of protecting financial customers and the investors have been transferred to the NFRA, which is a new national financial regulatory body. We will wait and see how NFRA will exercise its powers and function. So to recap, what we have seen in the China's financial regulatory revamp early this year, the Chinese financial regulatory framework is still evolving in the foreseeable futures with different emphases on certain aspects in different phases. reflecting a flexible and pragmatic approach. So one of the most important pragmatic approaches is to keep opening up the Chinese financial market. So we will talk about the multiple ways to access the PRC futures market. I think you already know that now foreign investors may have direct access to the PRC futures market through two cross-border channels via the QFII regime and trading the internationalized products. Also, they can set up their local presence like a wholly foreign-owned entity or joint venture in China to trade domestic futures option contracts with their legitimate RMB income. Also, there's always an indirect way that trading foreign structure products or OTC derivative products that is linked to the onshore underlying assets such as futures and options contracts. So here we have a matrix to set out a high-level comparison between three different channels. Now for the QFII models, we have 39 contracts, mainly the commodity futures and the options contracts available to foreign investors. We have 23 contracts available for the international products. Some foreign investors may ask, like, these two channels seems to a little bit competing with each other. But based on our observation, it is the Chinese financial regulators are keen to see that we are now offering different channels to different types of foreign investors. So they are willing to see that there may be a little bit competition between different channels. While for the WFI and the JV model, since it is locally incorporated entities, it should have access to all the available contracts now. For the entry threshold, definitely QFII will have a higher access conditions. Although since the 2019, the update of the QFII regime, the CSRC has relaxed the threshold to apply for the QFII, but now the regulator will still look into the profile and the background of each QFII applicant, will assess their investment track record, their risk control and the compliance regime to see to evaluate it from a very comprehensive manner to determine whether to grant this QFII license. But for the international products and the JV WFI and the JV model, definitely it has a lower market entry threshold. Also for the QFII, it has a kind of stricter disclosure requirements. QFII are required to make monthly and annual filing through reporting to the CSRC through its custodian bank. Also, if there's any change to the basic information of the QFII or any change to the investment plan of the QFII, it needs to further report to the CSRC. For the tax part, I think Alex's presentation has covered this part. We will just skip it. Here we set out an estimated timeline, like for a foreign investor to kick off the project till the day they can start trading. For the QFII model, probably it takes 1 to 3 months to obtain the QFII license, provided that if all the application documents is submitted to the CSRC, to the sentence factory to the CSRC. But also it may take another 2 to 4 months to open the bank accounts and open the futures account. For the international products model, definitely the timeline, the process may be streamlined. You only need to open an NIA account and the futures account with the futures broker. While for the WFI and the JV model, first you need to set up your local entity and open bank account and the futures account. And it may also take some time for the WFI to obtain legitimate RMB income to fund its futures trading. So it may take longer time. But for the JV model, probably the foreign investor can rely on the capital from its onshore partner to fund its futures trading. The timeline may probably can be, to some extent, can be shortened. So, so we can see each of these channels may have pros and cons, and there's kind of no perfect solution. But we have also seen that the update of the QFII regime since 2019 is still very exciting and attractive to foreign investors. There are increasing number of QFII license holders with different background, hedge funds, prop trading firms, and some of offshore market makers. Recently, some traditional multinational physical trading firms have also been granted the QFII license to access the PRC futures market. So therefore, I will spend the last few minutes on the QFII regime. So China has this real name account system, which is different from other countries that prohibits that an account holder to lend its futures account to others or borrow others' futures account to engage in any futures trading. Otherwise, the regulator can step in and penalize in accordance with the latest PRC futures and derivatives law, we call it FDL. But some US-based investors may have encountered this US person issue. Actually, we always tell our clients that this is not purely a PRC law issue because the PRC laws do not explicitly impose any like prohibition or restriction on a US investor trading in the PRC commodity futures market. But in practice, the exchange and the CFMMC impose certain policy restrictions on account opening by a US person investor, meaning because they are concerned that the relevant exchange or the PRC futures broker may be subject to the kind of approval or filing requirement with the competent US regulatory authorities or regulated by the US regulatory authorities when onboarding any US clients. So in practice, we have seen that the exchange will not grant a trading code to US person at the moment and further require other foreign investors, including those foreign investors trading the international products, to sign an undertaking letter representing that they are not a US person. So we understand that the foreign investor shall first assess whether the circumstances pertaining to a US person specified in this undertaking letter apply to it before it decides whether to issue this undertaking letter. So at this point, so it seems like this letter will become a US law issue. And ultimately, the exchange has this discretion to determine whether to grant this a foreign investor a trading code based on the undertaking letter and the identity information of the beneficial owner disclosed in our foreign investors application documents. But based on our recent experience is that if the foreign investor itself is not a US person and has issued this undertaking letter, in general, the exchange will not look through and trace up to the foreign investors' ultimate beneficial owner to verify whether this UBO is a US person. For the QFII to open a futures account, another commitment letter should be also issued regarding its overseas swap position. So here we set out the specific wording in the commitment letter. The QFII is required to undertake that the trading of commodity futures, commodity options, and the stock index options. Actually, a stock index futures is also included. Through the QFII channel will not involve structured products business and the cross-border derivatives transactions entered into with local securities companies or related hedging transactions. This means that a QFII must cease its overseas structured products business or cross-border derivative business that is linked to the domestic futures and option products, unless it has no plan or will not trade in the domestic futures market directly through its own QFII channel. So although the QFII license holder issued the this commitment letter at the entity level, so we know that like for the global asset manager or prop trading firms, they have different fund products or different trading desks. For the products that have already accessed the PRC futures market through this QFII channel, definitely they have to stop their overseas swap trading on the PRC futures contracts. But for other products that have not started QFII trading, arguably they can still keep on their ongoing swap trading, overseas swap trading. But they should, the foreign investor should also evaluate the relevant compliance risk, whether the de facto control account filing would be triggered. So although the current PRC law do not explicitly prohibit or restrict any overseas OTC derivative trading with linked to PRC underlying assets, the legality and the compliance of such arrangement may be still kind of questionable for breach of any look-through regulatory principle under the futures and derivative law. Also, since the underlying assets is onshore domestic futures and option contracts, there may also be breach in the real name account system established under the FDL. Someone may argue that there's no case precedent or enforcement cases against foreign investor, but we have already seen some case precedent in the securities market. The PRC financial regulators can still look into the substance and determine whether there's any violation and impose the penalty. So we need to bring this to your attention. Also, the PRC financial regulators have the legal basis to penalize foreign investors in accordance with this extraterritorial jurisdiction under the FDL. Also, the QFII rules give the CSRC right to require QFIIs to report its overseas hedging positions related to their domestic futures investment. Next topic, we'll talk about the program trading. So some foreign investors worry about whether the CSRC will impose any further regulation over governing the program trading. We all know that each futures exchange have already put the program trading under its regulation and require filing of the program trading for a while. And now the FDL have this very generic provision and gives the regulator discretion to decide when to issue detailed regulation over the program trading. So we can understand that the PRC regulator actually is taking a very pragmatic method to make it like step by step, not in a rush, because we know the program trading evolves with the technology development. The regulator also want to make sure that the detailed rules, when it come out, it will not be outdated. So probably at the law or statute level, it does not make sense to give a very detailed definition of the program trading. But at the exchange level, the exchange rules will have very broad definition of the program trading to capture all kinds of automated trading or algorithm trading. So also recently, we can see the CSRC consultation paper on the trading server co-location. We understand the QFII can also fall into its jurisdiction. So it may take some time for the PRC regulator to come out new regulations to see whether more information disclosure requirement or information filing regime will be adopted, and then we will keep monitoring. So probably we will not go into details about this de facto control account filing, which is a very unique system in China, time-wise. But we want to still remind that if a foreign investor failed to make this filing, because this filing requirement has already been seen in the relevant exchange rules, also the exchange has very broad criteria for this de facto controlled account filing. But if a foreign investor, for example, of QFII fails to make a filing, now under the FDL, it's a breach of law, which means that the QFII may face administrative penalty rather than the exchange's disciplinary measures. So the foreign investor really need to think about that. So to summarize, we always tell our clients we are always here. We are the eyes and the ears of the foreign investors. We will recommend all the foreign investors to closely monitoring the market developments and assess the regulatory policy changes. We also always encourage them to speak to their external counsels, or also some local counterparties like very prestigious futures brokers like Nanhua to find more business opportunities in China. So that's all my presentation today. Thank you.